for this. These are some of the biggest opportunities you will get on any month. Now, the focus of the central bank is monetary policy. And the idea is they use this to control inflation and also to create price stability in the economy. Some governments, central banks do vary it a little bit more to control exchange rates, but we're going to focus just on the monetary policy side of it. So, brief few things that you need to remember. They are going to control inflation and create stability through either the supply of money supply, or cost of money. And the cost of money is the interest rate. They're two tools that a central bank has, really, or they're the two goals or two ways that they can affect inflation. So, how do they do it to start with? Rates. Key rates you need to remember. Now, these vary by central bank, but essentially you will have a refi rate, refinancing rate. That is the cost to do business with the central bank. So that's the commercial bank's costs in terms of interest, and this then gets passed on to customers. That's the key thing you need to remember there. That's what the refi rate does. So any market operations between the banks that operate via the central bank and the central bank itself, the refinancing rate is the rate that will be used and is then passed on. It's essentially the rate for loans to the central bank, loans from the central bank. Now, next up, you have a deposit rate. This is for your excess reserves. So, banks have to keep a certain amount of money on deposit at the central bank. They can then put additional money at the central bank as well, money that they have not lent out, and receive some degree of interest on it. Now, what can actually happen is you end up with a situation of negative interest, which we've seen from the ECB. The idea is to force the banks to take those excess reserves and lend them out, so create more money in the economy. This then, the extra money supply, pushes up inflation. That was the goal of the ECB, to push inflation up. So that's the key thing with the deposit rate, is how much banks can earn on money that they leave deposited at the central bank. Now, obviously, the increase or decrease of rates is going to affect borrowing, and that is what's going to affect the country as a whole. It's going to affect corporate bonds, government bonds, it's going to affect home loans, mortgages, car finance. So generally, rates going up, borrowing going down. And this is how they control the economy, by limiting the amount of money that people can get access to via rates, because you are less likely to want to borrow at a much higher rate. So next up, we can go on to the money supply. How do they affect money supply? Money supply is affected via refinancing operations. And if you remember, you'd have a repo and a reverse repo. The idea of the repo is central bank they buy government bonds from commercial banks, buy bonds, and what happens when you buy something? Cash goes the other way. So money supply is increasing on the reverse repos. This is where the refi rate comes in as well. It is used for these refinancing operations because these essentially will be a loan. The bonds will be bought for a certain period of time rather than just bought and it's done. So that is what is termed as sterilizing. So sterilize. The bank will send out the cash, but ultimately they will want it back, and this comes in the form of a reverse repo, where the central bank sells the bonds and takes the cash back from the commercial banks. This reduces money supply, and so as you've got less money in the economy, you then see a slowing down of buying, and so a slower, lower inflation. Final thing is reserve requirement. Banks must hold a certain amount of money with the central bank. So if they boost up the reserve requirement, the reserve requirement is a percentage of your total assets, or the total assets that can be lent out. So say it's 10%, then you've got to always hold 10% of that at the central bank. If they boost it up to 20, you can then lend less money because you've got to have 20% held at the bank. So again, that's how they can reduce the money in the economy. Not particularly well used in Europe and the US, but it is quite well used by the PBOC, the People's Bank of China. They will use reverse repo and the reserve requirement rate quite extensively. So do watch out for that, any moves in that. The key thing with PBOC, they are ad hoc in announcements, and the key thing is their benchmark rate. That's the one that will get the move, rather than the RRR refinancing requirement rate, or reserve requirement rate, I should say. So, your major banks. We focused on ECB, Fed, and Bank of England. So what you're going to have to need to know, and you've got to be really set on this, know these things. You want to know their rates, or the rates that people focus on. So with the ECB, that's your depot and refi. With the Fed, it's the Fed funds rate. And with the Bank of England, it is the target rate. You also are going to want to know any extraordinary measures. Now, these can change over time, but with the ECB, you've got QE. The Fed doesn't have any at the moment, and Bank of England has QE. So know what those measures are. Be very clear on those, because at any point that they can change is going to give you a big opportunity. When do they meet? They all meet the same. It is 8 times per year. So make sure you are always there for them. You know, if you look at it this way, just from these 3 banks, you have got 24 meetings a year. That's 24 very, very big opportunities every year. So know these, know exactly when they come out. Also, with these meetings, know the format, what happens. So with the ECB, you get a press conference. With the Fed, you get 4 press conferences. And these come with staff economic projections, which we'll talk about in a moment. And with the Bank of England, you have the QIR, the quarterly inflation report. That is when they also have a press conference. That's the one to watch, and obviously there are 4 of those. So with the ECB, you get 8 conferences. With the other 2, you will always get a statement from them. However, you will only get any kind of Q&A every 4 from the Fed, or 4 times a year from the Fed or the Bank of England. And always, when you are trading these, think about the market expectations, what they actually are expecting to come out of these meetings. That's going to influence trade. Finally, their mandate. So what the central bank's role is to do. With the ECB, it's employment and stability. Which is very much the same as the Fed, price stability. Price stability and employment again. And the Bank of England is its government set, so it is whatever the government has set it to be. At the moment, it is a government set inflation target. And that is set at 2%. And this is symmetrical. So therefore, it is as bad to be below it as it is to be above it. So they're the key things. One last thing with ECB, they want inflation below but close to 2%, not above it. That is the difference between the ECB and the Bank of England. So remember those key facts, get those down. They're the things that you're going to really need to know. Now, in terms of actual trading, key things are going to be, with the ECB, it is all about that statement to start with, followed by the press conference. So what you want before any ECB meeting, you need to know what the key areas are that they could talk about, and also how that is going to impact the market. So what could they say in the statement? It has previously been that reassess line that we talked about. That's what could give you a bit of a move. So be very aware of what the statements could be, what is going to create you a move. Again, with the Fed, you have dots with the Fed. These are the staff economic projections. This is where each member sees rates going in the coming future. And so a shift in dots implies more interest rate hikes. Therefore, you get a move in the markets based on that. The Bank of England will have a vote count, so you will actually see how their members voted. There are 9 members, so you will have some iteration of 9-0, 8-1, 7-2, 6-5, sorry, not 6-5, 6-3, etc. And again, all of them are going to have a statement. So when it comes to trading, you've got to know how the statement's going to come out, how it actually appears on your news terminal, and what you're going to trade straight off it. So that's the key things. In terms of language from the ECB, they use either direction for rates, the Bank of England, and with the Fed, rates are described as moving gradually at the moment. So any kind of change of that, again, gives you a signal as to what you can actually do on it. Now, in terms of trading, very much like economic figures, you need to be considering the structure going into it. You need also to be considering different scenarios. Unlike an economic figure where you will get a number and it will either be a beat or a miss, you're going to have scenarios where a central bank will tell you one thing but then also have a slightly hawkish or dovish stance on it. So what scenarios, again, are going to get you really trading it? What scenarios are going to get you to put on a smaller trade? And again, what markets are you going to trade? So know all of those things before you go into it. Be ready to do exactly what you've planned, but stick to the plan. If you miss a trade, it's fine. If a trade doesn't set up or they don't talk about a certain thing, that's fine. It's better than diving straight in. Now, the structure is really important. We saw this on some of those examples. I urge you to go back and watch those videos. But if you've got a market that is flagging into the number or into the release, if you see something that gives you that continuation, you will get it. The move will be big. Remember that on the central banks, these create some of the biggest moves. However, we've also seen that structure whereby the market grinds lower because you've already had the announcement here that they're going to do something in terms of monetary policy. So the market is really pricing this in. What you then got to ask yourself is, what could they possibly do to get the market to continue lower? And if there isn't much, then what you can then be thinking about is, if you see this dip lower, are you then going to get this very fast reversal? And it's exactly what we have seen in the past. So they're the things with the central banks. Know the statements, know those taglines, know how the dots work with the Fed. They will just basically give you an expected rate for the end of the following 3 years. So know the dots at the time being, know exactly what the market's expecting as well. That's going to be key to your trading, and build scenarios. There's going to be likely 3, 4, 5 scenarios before any central bank meeting. Watch our preparation for it as well. We get scenarios from everyone on the trading floor, and that gives you a much broader idea. Perhaps it enlightens you to a few things you hadn't thought of. Now, finally, The other element to central banks are comments and sources. Now, these are more common from the ECB, and they will use it to sort of guide the market if they don't feel that their forecasts have come across properly. So you will get a sources comment come out. Now, these are, of course, ad hoc. You don't know when they're going to come out. So remember, have scenarios. What are you going to do in certain situations? You can start thinking about things that are going on. What could they mention? Could they, for example, at the moment, beginning of 2017, talk about a taper? Could they talk about repo markets? Could they talk about rates? This is all very important. So have those scenarios, know exactly what you're going to do, because the key thing is to assimilate the info fast. Assimilate it and trade. Know exactly what you're going to do. When you put the trade on, you want to be thinking about that as if it's a figure as well. So what do you expect? Where you think it's going to move? Where you're also going to get out of the trade as well. Watch any sources, watch for any type of denial. These are becoming less common at the moment, but denial will obviously, if the trade has gone one way, cause the trade to go straight back the other, and you know that people are positioned for it. So denial can often be one of the better opportunities. Also, marginal return on comments. The first comment is most important. Anything after that, particularly if it's a reiteration, is going to have less and less importance and can actually end up doing the opposite. So you will see a comment being the same as a previous, you'll see the market jump up as a few new people buy it, and very quickly all of these new buyers will get sold to and the market will come off. So if you've heard it before and you see a quick move, often that is a good opportunity to fade. So make sure with the comments, with the sources, you also know the doves and hawks at each central bank. That's going to be very key, because if someone says we're going to hike rates, but you know that they're very hawkish, then it's not such a surprise. You know that they're more likely to ask for that. It's if you get a dove for a hike, that's when you know that there's a bigger trade. So again, have them written down, know exactly who the members of the different boards are, know how they lean as well. That's where you're going to do well from the central banks. So it is all on the prep. Know exactly what you're looking out for. Know exactly what you're going to trade. And remember, this can be a big opportunity. Don't miss them. These can be some of the biggest opportunities you're going to get throughout the month. This is where policy actually genuinely changes, and monetary policy is the biggest influence on the economy as a whole. So watch out for that. These are huge opportunities. Be prepared for them.